Yo, what's up guys? This is Say Inch China. Welcome back to our channel. Today we're going to be learning about something interesting as usual, right? So make sure you watch this video all the way up to the end. And if you're new to this channel, make sure you subscribe to this channel, you like, you comment, and you also share this channel to your friends, right? To those who have been supporting this channel, thank you guys for your support. We are seeing your support. I promise I'll continue to send stuff that is important to your trading, that will help you improve your trading, right? Okay, so in today's lesson, we're going to learn about trade entries, right? Remember, we talked about structure, we talked about imbalance, we talked about order blocks, but now how do you get to execute your trade, right? So we're going to learn that in this session, right? So make sure you listen attentively and you follow everything that I'm going to teach you in this lesson, right? The concept is going to be very, very simple, but very helpful. So let's get to it and let's get to learn, right? So today we are learning about the two types of entries that we have in the Forex market, or that I use with my team in trading, right? So the first type of entry, without wasting much of our time, we have what we call impulsive or aggressive entries, right? Okay, so we are saying you've done your analysis on the higher time frames, you've spotted your supply zone, you've spotted the order block that you're going to use, right? So you might see that some prefer to take their entries from the higher time frames, right? That is the H1, the H4, the D1 is very correct, and you can do that, right? And some also prefer to take their trades at lower time frames, right? So the structure, you will just do the structure as you do, or as we learned here on this channel, right? Then when it comes to the very time that you want to place a trade, this is when you are going to apply this concept. So it's a concept that is going to be applying on every other time frame. The time frame that you choose to take your entries is going to apply, right? So the first type of an entry, right, is what we call impulse entries, or impulsive entries, or aggressive entries, right? So let me explain a little bit, right? So I just took an example for a downtrend. Say we are in a downtrend, right? We'll have gotten our corrective move in that downtrend, right? Now we expect the impulse end, right? So what you have to do, you have to wait for the market at least to move into the direction that you want, right? If you want to sell, you can't sell whilst the candlesticks are actually bullish on the very time frame that you want to enter the market. So you wait for the very time frame that you are in, where you want to take your trades from, right, for the market to move in the direction that you want, right? So if you want to sell, you are going to wait for the market to turn bearish like this, right? First bar, second bar, or third bar, right? You wait for where the market is going to give you a break, right, or a small consolidation, right? And you take advantage of that consolidation, right? So in this case, we had 1, 2 bearish candlesticks, then we got a bullish candlesticks, right? So what you do here, you simply wait for a breakout of this what candlestick, where price is going to break below this candlestick, right? So this type of an entry, you are going to place it the very moment the next candlestick breaks this one and at its close, right? So you wait for these candlesticks that breaks below this yellow line, or that breaks below the wicks of the previous bullish candle there. The moment price breaks below and this candlestick closes, you wait for candlestick closes. The moment this candlestick closes, you jump into the market, you join the market, and you sell right at its bottom, right? So these are called aggressive entries, but there is a condition to these aggressive entries. You should make sure that the candlestick that breaks this range or this consolidation should have volume. That is, that candle should be a little bit bigger, or it should be bigger than the candlesticks that are within that trading range, right? It will be introducing volume into the market. That volume candlestick will tell you that there is more volume. We are going to continue in that direction, right? So if there is no volume, you are not going to take aggressive entry. You take the other type of entries that we are going to explain. So the moment the candlestick closes, you jump into the market, right? And your protective measure, that is your stop loss. Your stop loss will always go above the wick, right, of the bullish candlestick, right? That is right there. You go straight to where the wick is. It's slightly above that candlesticks. That's where you put your stop loss, right? Remember, in Forex trading, you should always risk your entry reason. Just limit your risk to your entry reason. The moment price goes above or beyond the entry reason, then that entry is violated. You look for other entries, right? So you're going to limit your risk to just that one candlestick that has been broken, right? That price that has been broken, right? So basically this is what we call impulsive or aggressive entries. Very simple and straightforward. We'll get to the chart and get to see some examples, right? Hopefully I'll get a live example that I'll explain with, right? Then the other type of an entry, very, very simple again, is what we call retest entries, right? So on both of these entries there is a breakout that should happen, right? Or price should range or consolidate a little bit, right, before we jump into the market, right? So say we're in a downtrend, or sorry, say we're in an uptrend, we got a corrective move, we got an impulse move, we got a corrective move, sorry, we got an impulse move, we got a corrective move, right? Now we got into the demand zone, right? Inside the demand zone, we step maybe to lower time frames to look for the entries. Now when you want to take your entry, you wait for your price to move into the direction that you want to go in. That's the first thing. So if you want to buy, the candlesticks have to turn bullish. The market has to turn bullish first. So now when the market is bullish, we are taking advantage of the momentum that will have been what? Built up, right? So now when the market is bullish, now we look for our entry, right? So now what we have to wait for here, a little consolidation. You see the market consolidates like that. After that consolidation, or after this red bar, you wait for a candlestick that will break the highs of these two ranging candlesticks, or this red candlestick, right? Make sure that the breaking candlestick one has volume as well, and it breaks above the wicks of this red candlestick. So after you see that, you don't enter after this breakout candlestick close. You have to wait for your retest, right? So you wait for your retest, the price rejects, the price retests, and the moment it starts to reject this very red candlestick, you can start taking your entries there. And as to your stop loss is simply going to come below the wick of this red candlestick that has been broken out there, right? So the simple difference here is, on retest entries, you might actually miss some trades whilst you are still waiting for a retest. Many times price don't retest, it just breaks out, then price moves with a what? With an impulse entries, right? So it's all up to you now to weigh the options that you'll be having there, right? Whether you're going to risk on the impulsive entries. The moment you get the impulsive breakout, you jump into the market, you put your stop loss way above the what? That very green candlestick, right? Or you're going to wait for a retest. The advantage of the retest entry is it reduces the risk, right? Your risk will be minimum, right? Your risk will be minimum, your stop loss range will be small, right? At the same time, you avoid the risk of fake breakouts, right? You avoid the risk of what? Fake breakouts, right? In this case, in the case of impulsive entries, that is the disadvantage. At times, price might give this break as a false breakout. Many times, if there is no volume, like I've said, only take these entries when there is good volume in the market. When this candlestick that breaks shows you that there is volume, it should be relatively big than the previous what? Candlesticks, right? So the only disadvantage, like I've said, it might be a false breakout. So this candlestick can actually break out, right? Then the following candle changes direction, comes and hits your stop loss. So the advantage of this one is the disadvantage of the what? Of the other one. So let's go straight to the chart and look into some examples that we have. Okay, let's get to the chart. So we are on the chart. This is GBP USD, the daily time frame, right? So you're just going to ignore the time frame that I'm using, right? You are going to use the time frames that you prefer on your what? On your entries. What is important is the concept, right? So let's look at this very top. We are saying it's a region that you actually want to place a trade, right? Then the market starts to consolidate like this. It starts to range. It's moving in a sideways, moving. It's not trending, right? So all that you have to wait for is for a candle that will break below the lows here if you want to sell. So in this case, we got this first red bar, second bar, but they didn't actually close below the bodies of these candlesticks or even the wicks, right? So we'll have to wait for a candlestick that is going to close below this range, which happens to be this one. So this red candlestick managed to push and close below this. So the moment it closes below that, now we can take our what? Our entries. But unfortunately with this candlestick, it doesn't have volume, right? It doesn't have much volume. There's no volume in the what? In the market. So we'll wait for a retest, right? So in this case, you can see this next candlestick, it managed to move back to the region that has been broken out, to the range that price has broken, right? Price broke this range, right, with this candlestick. This one, before it moved down, it retested and left a wick there. So the moment it's retesting, you take your entries there, then you slide down with the what? With the entry, right? So you had options. You could take the what? The breakout candlestick, that is the aggressive entry, or you wait for the retest entry there. With both entries, you'll actually win with this candlestick, right? So let's slide and look at other examples that we are having there, right? So if you look at this chart very well, you see that this was a corrective move and an impulse, big impulse move. Then this is a corrective move. So we are saying as price comes to this very order block, you want to take an entry there, right? Prices reached this order block, right? You will have done your structure and everything that we learned. If you didn't get that, get back to the videos that in the previous sessions that I have recorded. You just go to the channel, look in the videos in this channel, and you learn the concepts of how you map your directional bias, right? So when price retraces back, comes into that order block, comes into that supply zone, you are going to wait for your market to tell you that we are going down, right? So in this case, price tapped the order block, it gave a one bearish candle, second bearish, right? So just after that, price started to consolidate. After the consolidation, we got this break there, right? And in this case, you can see that this candlestick is relatively big compared to the candlesticks that are actually in this range. It's telling you that there is too much volume into the market. The market is ready to go down. So just after this close, you can actually take an impulse entry right there. So right after that close, you take your impulse entry, you sell. Your stop loss lies above this blue candlestick there, and you make that profit, right? If you miss this, you can as well wait for the retest entry with less risk. You join the market with that what? Retest entry. Still you make your what? Your profit. And the other thing now on these entries, make sure that there is enough region for your take profit. Like in this case, this is a corrective move, right? So mostly your take profit will actually be in this region. You look to the previous low that you have in the market there, that will be your target, right? And if you look in these candlesticks, you actually see that on a higher time frame, there will be some imbalances that the market should close. You also consider that, right? So this was another example, right? This was actually another example, right? After this close, you actually take an aggressive entry there, right? But if you're afraid of this risk, you wait for the retest there, and you end up with the what? With the retest. The good thing is we're trading in the direction of the what? Of the market, right? But if I'm to put something that we learned in the previous lessons, you will actually realize that let me take this scan box, right? We talked about premium and discount, right? So this is a discount zone, this is a premium zone. So in this case, you'll consider this entry that is lying in the what? In the premium zone. This entry, you might leave it. Why? Because it's now in the what? Discount zone. So in this case, we'll take this entry confirmation. You're just using the very time frame that you're doing the analysis, still you can win. So there's nothing like you have missed a trade there. So let's get to a practical example, an example or a live trade that I'm actually in, right? This is V75. I had to take this trade so that I just illustrate the concept that I'm talking about. It's on a live account, though I had to take it to the smaller risk there. Let me show trade levels, right? So this is on deriv, right? Took this entry on, it was actually on M5, right? Okay, it was actually on M15, sorry, right? So here I was supposed to take my entry in this demand zone, but unfortunately I missed the sniper entry. The end price was actually moving, so I wanted to just join into this trade, right? This is an impulsive entry. You can as well do it as price is moving like that, right? So I saw my candlesticks were closing be bullish, right? The first entry that I should have taken was here, right? So after this candlestick close, above this ridge, I was supposed to take an impulsive entry there. Then I move with this, but I had missed that. So I just told myself that I'm going to take a risk with this region, right? So what I saw, price managed to close above. This is just a bullish candlestick, right? told myself I'm going to take a risk there, right? Initially, my stop loss for this trade was actually in this region because I was willing to risk this because I'd missed 1, right, 2, right? So after this close, I took a trade there whilst this candlestick was actually moving. It's a impulsive entry, right? And you can see the way that is actually moved, why we are actually in a bullish trend and we are going. If you are to look at the M5 time frame, you can actually realize that within that region, price started to range as well, right? So I could have waited for this range, this impulsive candlestick, right? I joined the market there. So if I had seen this, I was going to enter the trade with this as well. It was also a very good entry position for this very trade. So this is about impulsive entry. Let's look at the very shorter time frame, M1 time frame. So on M1 time frame, taking the impulsive entries on M1 time frame, what is our confidence? Where is our confidence, right? Our confidence is in the trend that is in the higher what time frames on the daily time frame. So I would wait for this range. You see, price started ranging within this region, right? Then I would take an impulse move or an impulse entry at the close of this bar, right? Where will be my risk? My risk will just come below this ranging market. This is where my risk will actually sit. I might as well consider this candlestick. My stop loss will sit there, right? Either the impulsive entry there or the retest entry to this region. So price usually retests the consolidation zone there. I would even take the trade there. So guys, this is about the entries. If you want to learn more, guys, I also have a class that will be running from the 11th to the 16th of this month, April, right? I'll be having some mentorship classes, trading boom and crash, trading currencies, trading volatilities, right? So with the details that you're actually seeing on the screen, you can contact any of those numbers, communicate with our mentors, then you enroll to the class that we have, then you learn more about this forex trading, you learn more about our entries, right? You learn more about the structure, you learn more about our strategies that we teach here at Sniper X Forex Empire, right? So guys, don't forget to like, subscribe and share the channel. We will be happy to see this channel growing with your support. Thank you guys. See you in the next lesson.